of 268 pages. So the document consists of 268 pages, which means that it is obviously long, and you don't need to study the entire document. If you scroll down, so if you scroll down in the pages, then you will see that on Roman 6, page Roman 6, otherwise page 8 in the paging system on the top of the page, you can see the table of contents. Okay, so the table of contents. Actually, what is compulsory material? So what is compulsory material? Is the key messages on page Roman 10, so key messages, as well as the entire first chapter, so from page 1 to page 26, okay? So the first chapter, which is global investment trends and prospects, so global investment trends and prospects, and it has 3 sections, A, B, and C. A is FDI, foreign direct investments, and the COVID-19 crisis. B is 2019 FDI trends, and C is international production. So actually, this is compulsory material. What I would like you to know is the key messages. That's absolutely essential. And then I would like you to study Chapter 1, Global Investment Trends and Prospects, all together with sections A, B, and C. Chapter 2, Chapter Roman 2, Regional Trends, is very interesting. I'm going to touch upon it. However, it is not compulsory material, okay? So it is not compulsory material for the exam. And equally, chapters 3, 4 are also, and chapter 5 are not compulsory material. However, they are very interesting reads. So they are very interesting for a global knowledge on the global supply chains and foreign direct investments. First and foremost, I would like to underline the title, because the title of the document is always World Investment Report, WIR, and the given year that it reflects on. However, there is always a subtitle of the document, which is, in this case, International Production Beyond the Pandemic. So actually, this document is hugely interesting. I do recommend reading the entire material, because the concept is that basically we are trying, or UNCTAD is trying to estimate what is going to happen after, so what is going to happen after the pandemic, how global value chains will tend to change after the pandemic. And without being very vague, or without being very fuzzy, so I'm going to be very precise and exact with you, the outcome is that instead of global value chains, production is anticipated, is projected to sink or to shrink into a regional playground or a regional field, I would use the expression. So production is going to shrink into a regional field, into a regional scope. And the global value chains are estimated to break up, and regional value chains, multinational corporations or transnational corporations, are expected to operate on a basis of a regional integration, as opposed to a global network of enterprises. So it is quite interesting and saddening, because it is the global value chains that have been developing since the Second World War, basically, are subject to break up, to diminishing, to shrinking. And it is anticipated that we are going to face more and more regional multinational companies as opposed to global multinational companies, which is quite saddening, in fact. So this is the outcome of the document. And this is why I'm telling you that it is worth reading. Okay, so let's scroll down. So let's go scroll down, and we would like to. I would like to go directly to chapter 1. So I would like to go directly to chapter 1, which starts on page 19. Okay, so page 19, if you look at the calculator on the top of the document, it is page 19, global investment trends and prospects. I would like to mention that in each and every year, the document is reflecting the performance of the previous year, and they are giving an estimation for the given year. So it means that they are calculating with data for 2019, and they are giving estimations for 2020. And actually, the 2001 World Investment Report will have exact figures for the 2020, and it will give estimations for this year. So I would like to clarify that everything that reflects 2020 is more an estimation than an exact mathematical calculation. Okay. So I would like you to go to figure 1.1 on page 20. Okay, have you got it? Can I have a feedback, please?
Yes.
Okay.
Yes.
So on page 20, figure 1.1 reflects on the global FDI inflows between 2015 and 2019, and it also entails a forecast for 2020 and 2022. The interesting thing is, what I would like to underline, that in 2015, the total amount of FDI inflows was around $2 trillion, which is 2,000 billion US dollars. So once more, $2 trillion, which is once more 2,000 billion American dollars. I would like to stop here. So this is quite interesting, because in 2008, just right before the financial crisis, so we do know that the global economic downturn of 2018 would hit the world in late September 2008. So actually around the 25th of September 2008. And for this reason, the results of the 2008 crisis, so global financial crisis and economic downturn, were experienced in the year of 2009. This is very interesting. Because just before the 2008 crisis, it was $1.8 trillion. So it was $1.8 trillion before the 2008 crisis. And there was a massive drop of approximately 60% to 2019 to 1.2 trillion. So between 2008 and 2009, global investments fell from $1.8 trillion to $1.2 trillion. Why I am telling you this, so why I am sharing with you this piece of information? because the situation is very, very similar. So the situation is very, very similar right now. The difference is that actually from 2008 until 2019, so from 2008 till 2019, global foreign direct investment inflows, so I am underlining the inflows, couldn't weren't able to catch up to the pre-crisis standards. And as you can see in this chart, in 2019, so just 1 year before the pandemic, the COVID-19 pandemic, the total amount of global FDI inflows was 1.5 trillion US dollars, so 1,500 billion US dollars. It is quite interesting because it is important to know that between 2008 and 2019, the global FDI inflows were unable to catch up, were unable to recover. Recover is the best terminology. Were unable to recover. So actually, when the crisis hit the world in 2020, we were under the level of the global economic downturn of 2008. So it is very important to know that we were under the level of 2008. So to compare to this one, we can see the approximation. So compared to 2008 and 2019, we can see the approximations. So we can see the numbers. And to understand the numbers, we will see how deep we are going to sink. But actually this year in 2021, we are expected to receive $1,000 billion, so $1 trillion of foreign direct investment, which is basically half of the FDI inflows that were represented or that were presented just before the 2008 global economic crisis. So actually we are very deep down. So we are very much deep down. Actually, it is half of the amount that we used to have 13 years ago. So this is not an advancement. It is a very serious backdrop. So it is a very serious loss. And I would like you to go to figure number 1.2 on page 21. Actually, the impacts of the pandemic are not expected to stop in 2021 or 2022. These are only the short-term impacts of the crisis or the medium-term impacts of the crisis. In 2030, so within 10 years, long-term effects are also expected. So long-term effects are also expected. And these are listed below. So first and foremost, on the short term, at the end of last year and this year, when the crisis would strike, the immediate effects were the slowdown of the implementation of the ongoing projects due to closures of sites, but also shutdowns in cross-border mergers and acquisitions and new project starts. So actually, the very immediate effects of the crisis on foreign direct investments were that everything was put on a hold immediately. So all the investments that were started in the year of 2020 were pushed a stop button on, and nothing was going on. Actually, the other short-term effect of the crisis and an automatic effect was on reinvested earnings as a key component of FDI. I'm going to explain it immediately. We are going to have another slide on reinvested earnings, but this is important to understand that reinvested earnings are generated by multinational enterprises or transnational corporations. These are the earnings of existing companies that are not distributed as dividends to the company owners, but they are held by the company and they are reinvested into the industry. These are the sources of investments by which a given multinational company expands. So once more, a reinvested earning is an earning generated by the transnational corporation or the multinational enterprise. And the point is that basically the profits of the company are not distributed among the shareholders or the management or the employees of the company. Rather, they are reinvested into the same industry, most likely in the same country where the company is located, I mean in the host economy, and very, very likely in the same city where the investment is located. And actually, these are sources of investments for the company within a host economy. So this is why I'm telling that basically 50% of the investment worldwide are deriving from reinvested earnings of existing transnational corporations. And this is why I am telling that it is a real tragedy. So this is a real tragedy that it is going to shrink on the short or on the middle run. Okay, so the next short or midterm effect of the crisis will be the reduction in cross-border M&As. We need to stop here, and again, I need to explain. So there are many forms of investment. So there are many forms of investments as for foreign direct investments. However, we need to know two major or two primary sources. One is the so-called greenfield investments. So one is the so-called greenfield investments. And the other one is listed here that is called mergers and acquisitions. So it can be cross-border, obviously, but the point is mergers and acquisitions. In the case of greenfield investments, what happens is as follows. A greenfield investment is a very symbolic name of a transnational investment, because what happens also here in the city of Győr, we have an industrial park outside the city, which is located in the south of the city. So basically in the southeast corner of the city, the Győr Industrial Park is located. And it is full of greenfield investments, because what happened was the city allotted a field that was derived from agricultural investments. So that was derived from agricultural investments. And it was converted into industrial investments. So it was no more an agricultural arable land, but it was converted into an industrial area, into which the Hungarian government invited foreign investors. And this is how, in the early 1990s, the industrial park of the city was created. This is a global pattern. So obviously it doesn't only happen in Hungary or Eastern Europe or within the European Union. It happens globally. So these areas, these industrial parks, are more often than not taken out of the agricultural production and converted into industrial areas. And this is where greenfield investors are coming. And this is why the terminology was born, greenfield investments. The other terminology is what you can see in line 3, M&A. So M&A once more stands for mergers and acquisitions. And a merger is when two companies merge into one. So M&A is when two companies merge into one. And acquisition is obviously when a bigger company procures a smaller company. So when a bigger company acquires or procures a smaller company, and actually two become one. So the difference between greenfield investments, so the real difference between greenfield investments and mergers and acquisitions is that while greenfield investments entail the establishment of something new, so creating something new, in the case of mergers and acquisitions, basically two already existing entities, so two or more already existing entities are merging into one. And I'm going to stop here once more. It is a real tragedy, and I tell you why. Because previously, so I'm telling before 2020, so when the expansion of global value chains started at the end of the 1980s, so throughout the 1980s, the 1990s, throughout the millennium, around 2010, so the European sovereign debt crisis. So throughout basically the last 40 years, I'd say throughout the last 40 years, obviously, we were experiencing many forms of crises, so many forms of economic downturns. But when we were looking at investments, so specifically the accession or the merging of the capital markets, throughout crises or throughout downturns, we used to experience the diminishing or the decrease of greenfield investments. However, mergers and acquisitions were always the survivors of the crisis. In fact, in some cases, mergers and acquisitions even would grow, even would rise throughout the crisis, because the smaller entity went bankrupt and the bigger entity would purchase the smaller entity that would go bankrupt. And actually, the crisis had a concentration effect. So capital was concentrating throughout the crisis. So the anticipation in row 3, in line 3, that there will be a reduction in cross-border M&As is a tragedy, because it means that not only foreign direct investments in forms of greenfield investments are going to decrease, but the more stable mergers and acquisitions are also going to be reduced, which is very sad. So actually, it is a real shrinking in the process of global value chains. Okay, let's look at the midterm, long-term effects by looking at the global economic recession. Actually, this is the end result is going to be a shelving of projects and a drop in new investment decisions. So actually, those companies that were anticipating to invest into new areas of the world, those companies that were considering of going global, actually were dropping their ideas, and they were shelving these projects, and they were conserving these projects and postponing them for many years or decades. And the last thing is the most severe, the most devastating outcome It is basically divestment, reshoring, and diversion, which means the previously global companies or companies that used to have production plants or service plants or affiliates abroad might decide on divesting, reshoring, taking home or taking closer, or diverting their original intentions. So actually, this crisis, this pandemic is huge. This pandemic basically forces companies to rethink everything, to drop original ideas, to stop reinvested earnings translate into new companies, to stop the establishment of mergers and acquisitions, and on the long haul, even the shrinking of a big transnational network. So this is quite gloomy. So this is quite gloomy. I would like you to go to page number 23 to figure 1.3. So to figure 1.3. I told you previously just a few minutes ago that I'm very much surprised at the decrease of mergers and acquisitions. Because normally throughout the downturns, the economic downturns, greenfield projects are on the decrease, but normally cross-border M&As are constant or on the up and up. Actually, last year, I mean in 2019, there has been already a decrease in both of greenfield projects and cross-border M&As, though the drop in M&As was 9 percentage points less than the drop of greenfield projects. However, if you look at the 2020 monthly average of 2020, which were the first 3 months of the year before the World Investment Report was concluded, you can see that both the greenfield projects and the cross-border mergers and acquisitions did drop by around 50%. So greenfields and M&As did recede equally. Unfortunately, M&As were not saved by the crisis, so they were no exception, unfortunately, which is very strange. Okay. Okay. So we can go through. Table 1.2. So we can go through table 1.2. I only would like to underline that, as we have seen in the previous chart, so 1.3, we have seen that 30% loss in greenfields and 21% loss in M&As was precedented in early 2020. I am looking at the last two columns. Roman 4 and Roman 5. And Roman 4 and Roman 5 come from the gray circles of figure 1.3. Can you see it? So actually, Roman 4 and Roman 5 in table 1.2 come from the gray circles, minus 30% and minus 21% of figure 1.3. Okay, can you see it? Can I have a feedback, please?
Yes, well,
okay.
I can see it.
So this is the same. This is what I'm talking about, okay? And what I would like to show you, as for greenfields, the average loss was 30%. However, if you look at the three industries, the primary sector, the manufacturing, and the services, then you can see that the manufacturing was the sector that was most severely hit. On the second place, it was the primary sector, and in the end, there were the services with a loss of minus 23%. If you look at the picture of the cross-border M&A deals, so mergers and acquisitions, then equally you can see that manufacturing was hit severely, but in this case, services were on the second place with minus 21%, followed by the primary sector by minus 9%. It means that basically the mining industry, mining, quarrying, petroleum, agriculture, forestry, and fishing was less hit by the crisis, specifically mining, quarrying, and the petroleum industry, where mergers and acquisitions were still going on. So were still going on, but at a lesser pace. I wanted to say pace. So at a lesser pace than throughout the previous year. Okay. Let's go down to table 1.3. Okay, let's go down to table 1.3. It is on page 26. Have you got it all?
Yes.
Okay, so what I would like to show you is as follows. It is the title of the title of the chart is FDI inflows and projections by group of economies and region, and the forecast for 2020, because we still do not have the 2021 figures. So on one hand, inflows and projections. Projections are projected obviously for annual growth rates, and inflows are calculated on regions and economies on a basis of billion American dollars. Okay, it is written in billions of American dollars, and the growth rates for percentages. So UNCTAD has a practice of listing 3 years, so 3 consecutive years before it shows results for the factual year. So it means if we are looking at the year 2020, we are always comparing the year 2020 to the performance of the previous 3 years, namely 2017, 2018, and 2019. So actually, what I would like to underline here, so what I would like to indicate here is as follows. In 2017, the total of FDI inflows was 1,700 billion American dollars. In 2018, it was 1,500 billion American dollars. I can see that it is 1,495, but this is what I'm saying, that I'm rounding up the numbers. And in 2019, it was $1,540 billion. So what I would like to say that even in 2017, which was a very good year in terms of FDI inflows, we didn't reach the 1.8 trillion, so 1,800 billion American dollars that we have reached in 2008 before the global economic downturn. So even the best year of 2017 did not correspond to 2008, which is quite surprising. So now we understand that 2020 will lead, so 2020 will lead to basically 920 to 1,000 billion American dollars. So this is what I am saying, that basically this pandemic has halved the results of 2008. So actually we are just getting farther and farther away from what we would like to reach. And actually we are not experiencing an expansion of global value chains. What we are experiencing is a contraction of global value chains, a contraction of global value chains to basically regional multinational enterprises. In the library, you can access a book written by Mr. Alan Rugman. He has a book titled Regional Multinationals. It is very interesting. Actually, he used to be a British author, and he has anticipated the strengthening of regional multinational networks more than 10 years ago. And it is very interesting to experience how his projections, how his anticipations have unfortunately come into reality. So what I would like to tell you, if you look at the world, then you see an absolute number. It is also interesting to observe that half of the global FDI inflows goes to developed economies, and also equally, approximately half of the global FDI inflows goes to developing economies. And in this case, developed economies are divided to Europe and North America. Developing economies are brought down to Africa, Asia, Latin America, and the Caribbean. However, there is a category of countries which is called transition economies. When we, 3 weeks ago, until 3 weeks ago, we were involved in the categorization, into the breaking down of nations into categories, because somehow we need to group the countries of the world. Actually, we have already become familiar with this expression, transition economies, which is the Commonwealth of Independent States. So Commonwealth of Independent States plus the countries of Eastern Europe and Southern Europe, so Southern Eastern Europe, that are not members of the European Union. So that are not members of the European Union. Actually, this category, this transition economic category, is only used by the UNCTAD. So it is only used by the United Nations Conference on Trade and Development. Other classifications don't really use the terminology transition economies. And actually, when the United Nations Conference on Trade and Development started publishing the World Investment Report in the early 1990s, these countries, so the Commonwealth of Independent States and Southern Eastern European countries that were non-members of the European Union, were on the up and up. They were on the rise in economic terms. I'm going to be very upfront with you. I do think and I do consider that all of these countries can be categorized as developing economies. So if you add up 685 in 2019 plus 55 equally in 2019, then you can see that approximately half of the FDI inflows globally did go to developing countries, and the other half did go to developed economies of the world. Presumably, the same thing is going to happen this year, and it also happened last year. So half of the global investments goes regularly to developed countries and the other half to developing economies. This is very interesting because before the millennium, the ratio was around 75 to 25%, and the bias was for the developed economies. But after the millennium, it was always approximately half and half. And there were some years when developing countries were basically outperforming developed countries in terms of FDI attraction. I don't think it is going to happen very soon, but it used to happen in some years after the millennium. Okay, let's have a look at growths. What I would like to show you that the year 2019 wasn't a very successful year. So it wasn't a very successful year. So actually, the world experienced slow growth in terms of FDI, 3%. Developed countries did experience a growth of 5%, the developing -2%, and transition economies experienced 59%. So apart from the transition economies, which did experience a huge FDI growth in 2019, the growth was quite moderate. And if you compare 2019 to 2017 and 2018, actually, we were experiencing losses. Actually, the entire world, didn't recover from the 2008 crisis. So actually, it was always the governmental stimulus that helped out economies. And actually, after the 2008 crisis, the European Union, specifically some countries, Italy, Portugal, Greece, Ireland and also Ireland were very severely hit with sovereign debt crises. So especially the developed part of the world was especially hit by crisis. So there was either negative growth, so decrease, or very minimal growth. So if you look at the last column, the projections of 2020, then you can see that all these losses, the global loss of approximately 30 to 40%, the loss in the developed countries from 25 to 40%, the loss of the developing economies from 30 to 45%, and the same that refers for the transition economies, is shocking, because the previous 3 years haven't been good either. So actually, it was a loss compared to 3 underperforming years. This is why I started with a statement that even in 2015, we have not reached the performance of 2008. So actually, the pandemic as an investment crisis, now I'm translating the pandemic into an investment crisis. So actually, the pandemic as an investment crisis hit the world without recovering from a previous one, so the 2008 and the 2010 global and European crisis. I would like you to go down to figure 1.4, please. So figure 1.4, please, which is on page 27. Can you see it in the down right corner, bottom right corner? Can you see it?
Yes, we can.
Okay. So what I would like to tell you is as follows. What is IPA? So what is IPA? Please have a look at the chart, and I'm going to explain you what IPA is. And I'm giving you the opportunity to write an activity hand-in on the topic of IPAs. IPAs are the so-called investment promotion agencies. So IPAs are the investment promotion agencies that are established in each and every country, normally under the Ministries of Foreign Trade or under the Ministries of Economy or under the Ministries of National Development. So it depends on the country, but each and every country has a so-called IPA, an investment promotion agency, that either it is a sub-organization, so in each and every country, it is a sub-organization of the Ministry of Foreign Affairs, the Ministry of Trade, the Ministry of National Planning, the Ministry of Economy. So it depends on what ministry your country has. So it depends on the ministry, what your country has. But the point is, so the bottom line is that each and every country wants to invite capital, investors, foreign direct investors into the country. And basically, this is an offer. So this is an offer, what we can offer to the foreign direct investors to kindly pick out, to kindly cherry pick, to kindly choose our own country. In the case of Hungary, this agency is called HIPA, so HIPA, the Hungarian Investment Promotion Agency. But for instance, in the case of China, it is called the CIPA, the Chinese IPA, Chinese Investment Promotion Agency. In the case of the Czech Republic, it is called the Czech Invest. So actually, if you come from different countries of the world, you must have, so I'm quite certain that your country has an investment promotion agency. And what is the reason? Because the tendency, so if a multinational company or a transnational corporation wants to go abroad, then first and foremost, the company chooses a geographical region. So for first and foremost, the country chooses a geographical territory, a geographical region. And within the geographical area, so I will say South America, North America, East Asia, Southeast Asia, South Asia, Central Asia, West Asia, Sub-Saharan Africa, North Africa, Eastern Europe, and so on and so forth. So these are the geographical territories that a multinational enterprise chooses. And within a given geographical area, countries are competing with each other. So for instance, if Hungary wishes to receive foreign direct investment, then we are not competing with Paraguay, we are not competing with Indonesia, we are not competing with Korea, we are not competing with Ghana, we are not competing with Ethiopia, we are not competing with Germany, in fact. We are competing with Slovakia, the Czech Republic, Poland, Romania, Bulgaria, Slovakia, Slovenia. So these are the countries that we are competing with. So actually the role of the investment promotion agencies is to look at the offers, so to look at the government subsidies of the neighboring countries, and basically to build an offer to the foreign direct investors. Actually, in a very funny fashion, I was once a member of a PhD defense board. So actually someone was defending his PhD, and he was an expert of the Hungarian Investment Promotion Agency. And obviously in our case, in the case of Hungary, this is a sub-organization of the Ministry of Foreign Affairs and Trade. And this candidate, so this PhD candidate, used a very interesting expression, and everyone was smiling, but I think it is a very illustrative expression. He said that the role of the IPAs is similar to restaurants, that they are running around among the competing restaurants. They are looking at the menus, what the neighboring restaurants are offering in the same district or in the same city. And actually they have to offer a better menu, or they have to offer a better menu with more reasonable prices or better offerings to be able to stay in competition. So actually this is the role of IPA leaders. So actually they are just running around the region, looking at the subsidies, what other countries are offering to foreign direct investors, to global value chains, and then they realize what their own country needs to provide. And actually, why is it important? Because actually, in figure 1.4, as you can read the title, the title is IPAs expecting an increase in FDI inflows, and there is a time frame 2016 and 2020. So actually, whereas in 2016, 76% of the IPA leaders were expecting an increase in FDI, it was less and less. In 2017, 61%, 18, 55, 56%, in 2019, 45%, and in 2020, only 7% of the IPA leaders expected a rise, an increase in foreign direct investment. Why is it important? Because IPA leaders are always very positive. So actually, I'm going to tell you the truth. IPA leaders' perceptions are always positively biased because these managers are evaluating, so these senior managers are evaluating their own jobs. So actually, if you are an head of the Hungarian or any IPA, and you are asked if FDIs are going to grow, or are they growing? Are they going to shrink? Are they going to diminish, or are they going to be less? Then, if you answer that they are going to be negative and they are going to decrease and they are going to shrink and they are going to be less and less, then you are evaluating your own job, and you are going to say that actually, in fact, you are doing a very bad job. We are delivering a very poor job. So because the IPA leaders are basically evaluating their own jobs, they are always positively biased. So to see their negative expectations is very discouraging, because it literally means that the situation cannot be really helped. So this is what it is, and full stop. And unfortunately, we need to adjust to the new practices, to the new situations. And please have a look at the figure 1.5. So the figure 1.5, it is also very interesting, because it was asked, so IPA leaders were asked in the first 3 months of 2020 if they are expecting a decrease or a significant decrease on a country level and on a global level. And actually, all the IPA leaders were either expecting a decrease or a significant decrease. But the funny thing is, and why I am showing you this figure, this chart, is because if you look at the comparison, then on the right-hand side, you can see the global expectations, and on the left-hand side, you can see the country expectations. And this is what I'm telling you, that on a country level, they are expecting a decrease, but to a lesser extent. On a global level, on a global playing field, they are expecting a tragedy. And this is why I'm saying they are more positively inclined for their own countries, because this is their responsibility. So for their own responsibilities, for their own duties, they are positive. But for the global trends, for the global FDI trends, unfortunately, they are very negative. So 90% of them are negative. And this is what reflects the global truth, unfortunately. Have you got any questions now? Do you get me? Do you get me? Have you got any questions at this point?
No, it's clear.
Is it clear?
Yes, it is.
Am I clear?
Yeah, it is clear.
Can you follow me? Because I'm speaking to 23 unseen windows. So this is why I'm asking. So you
Yes, we can follow you.
Okay, you can follow me. Very good. Okay. So it was section A. So it was section A of the first chapter. And actually, when you are asked about the crisis, so the COVID-19 crisis and the FDI trends in the exam, obviously it is going to be an oral exam because of the COVID-19. So you are kindly asked to explain that I have now explained based on these charts. Okay, you get me? So when you are asked in the exam to kindly explain FDI trends throughout the crisis, or because of the COVID-19 crisis, you are kindly asked to read these pages. So from page 20 to page 28, wasn't it? And you are kindly asked to explain what I've just said. Okay. And now we are going to B, the FDI trends. So we are going to section B of the first chapter, which is FDI trends. As you can see, as you can see, from 2018 to 2019, there was a very slight growth. So there was a very slight growth. And from 2018 to 2019, it was interesting because while the developed part of the world, so while the developed economies experienced a positive growth, marginal but positive growth, the developing economies of the world experienced a loss in terms of foreign direct investments. If you break down the developed parts of the world into two major regions, Europe and North Africa, then you can see that basically North America was stagnant. So the North American FDI inflows did not change from 2018 to 2019. However, Europe experienced a growth, and actually the crisis hit the developed parts of the world while Europe was on the recovery and while North America was stagnant. Interestingly, if you look at the developing economies, we have already seen that the transitional economies were gaining momentum before the pandemic. However, we also saw that the Latin American and the Caribbean region experienced a growth prior to the crisis. However, Asia, developing Asia and Africa were experiencing losses even before the COVID-19 pandemic. So actually, Asia and Africa were already on the decline in terms of attracting FDI even 1 year before the crisis. So actually, the ground was not similar. I would like you now to go to figure 1.7, but I'm going to tell a huge but here. This list, this top 20 FDI host list is given each and every year by the UNCTAD, so the United Nations Conference on Trade and Development. However, I need to tell you, I need to tell you very strictly that it doesn't really mean anything, and I'll tell you why. Because it is a constant subject to change. So the first 10 countries more or less remain the same, but it is very easy to be included into the bottom half of the list, especially the bottom 5 countries that are a subject to change. I'll explain you immediately and you are going to understand. So if you look at the United States of America, and the first line refers to 2019, then you can see that the United States of America in absolute numbers received 246 billions of American dollars in 2019 in the form of FDI inflows. On the second place, there was China, 141, then Singapore, 92, then the Netherlands, and then Ireland, and then Brazil, Hong Kong, China, the United Kingdom, India, and so on and so forth. But what I would like to tell you is that actually there were only 3 countries in the world that were attracting around 100 billion, around, because Singapore is 93, so this is why I'm saying around 100 billion or more, China and the United States of America. And if you look at the countries below Singapore, then you can see that there were approximately 7 or 8 countries that were attracting above $50 billion, namely the Netherlands, Ireland, Brazil, Hong Kong, UK, India, and Canada. All the other countries of the world were attracting less capital, so around 40 or 30 something, so 36, 36, 34, 33, 33, and so on and so forth. And what you can see, the bottom 5 countries, Italy, Cyprus, Indonesia, Sweden, and Israel, were basically between 27 and 18 billion American dollars. Each and every deal, so each and every business, each and every deal that is above $1 billion is called a mega deal. So a big deal is called a mega deal. Actually, in Hungary in 2005, the Budapest airport was purchased by a foreign investor for $5 billion. This is why I'm telling you, to reach a deal of $5 billion or even $10 billion or $20 billion is not really complicated. Obviously, it is a huge amount of money. I'm not suggesting that it is not a huge amount of money. I am suggesting that it is a huge amount of money. However, I'm also just suggesting that it can be a one-off, okay? So it doesn't happen every year, it doesn't necessarily have to repeat itself. It is only a one-off. And normally, there are not many countries in the world that systematically perform above $30 billion. Actually, these are the countries of the world where foreign direct investments are really concentrated, and they don't tend to change much. What I would like to tell you is as follows. Please look at China. China is on the 2nd place. Please look at Brazil, which is last year it used to be on place 9. This year, as far as I can see, it is on place 5. Please look at India. So please look at India. India is also on the list. And please look at the Russian Federation, which is equally on the list. What we cannot see is South Africa. However, all the 4 BRICS countries, I mean S is a plural, Brazil, Russia, India, China are on the list. So this is why these countries are so relevant in the 21st century global economy, because even if a crisis strikes the world, these countries are heavily attracting foreign direct investments, contrary to all the pressures delivered by the COVID-19 crisis. So what I would like to tell you here right now is that I'm asking you to kindly look at the top 20 host economies of FDI each and every year. But even if you are not anymore a student of our university, I'm cautioning you to read this list very cautiously, because the first 10 or 11 ranks places are almost always taken. However, the places below are always subject to change. Okay. I would like you now to go to figure 1.8, please. So I would like you to go to figure 1.8, please, and please have a look at the list. Actually, this is why we have learned the income groupings of countries according to the World Bank. Because now each and every one of you knows what high-income countries mean, what upper middle-income countries mean, what lower middle-income countries mean, and what LDCs mean, so the least developed countries mean. This is why I am always starting with country groupings, because now when we learn about foreign direct investments, we can understand what these country groupings mean and how relevant they are. So, as you can see, the majority of foreign direct investments goes to high-income countries, and a very tiny share of the global investment, and around $20 billion, go to least developed countries. And basically, the truth is that a less developed a country is, so the less developed a country is, the less capital is directed towards this country. Actually, foreign direct investors are anticipating good infrastructure. They are anticipating economic growth. They are anticipating populations. They are anticipating government policies that are subsidizing, that are supporting foreign direct investments. So actually, the less developed a country is, the lesser extent multinational enterprises are interested, because the preconditions of investments, so the preconditions of investments, the support system is not really created by the country. And as FDIs are a very important source of development for the developing countries of the world, it is very sad to decline, to shun foreign direct investments. I tell you why. Because the difference between foreign direct investments and foreign indirect investments is that foreign indirect investments are basically financial investments. And the only aim, the only reason of the investor in portfolio investments on the financial markets is to attain a growth, to attain profit, to attain a gain. However, in the case of foreign direct investments, this is why they are called direct investments. These investors are directly interested, involved, even incubated, embedded into the growth of a host economy. So it means in the case of foreign direct investors, the investor is embedded into the country's production or service system, and they generate exports, they generate GDP growth, they generate employment. Actually, in one of the World Investment Reports, I'm going to be very upfront. I don't remember which year. I cannot really remember which year. But in one of the previous years, in these World Investment Reports, it was written that FDI can be called as quality capital. So it was named quality capital. And quality is added because it entails job creation, so employment creation. It entails GDP growth. The FDI also, in many cases, entails exports growth. So the interests of the host economy and the foreign direct investor go hand in hand. So that's very important. So this is why when we look at figure 1.8 and we experience the truth that the less developed the country is, the less capital directs this country, is very sad, because the foreign direct investor is a source of development for each and every country, even for high income economies. Okay, let's go down. So let's go down. It is explained very much in detail. So it is explained very much in detail for the entire world. So it is explained very much in detail in absolute numbers and in relative numbers. So in percentage points, the share of the world FDI of each and every geographical region of the world. Before we go into detail, because you are going to be mad at me because of the numbers, so now you can see that global economics is not always easy, because you can see millions of numbers and you need to find the point that is relevant, and you need to filter out the points that are irrelevant. So first and foremost, I would like to draw your kind attention to the two main columns, FDI inflows and FDI outflows. How come that there are two different columns? Because normally FDI flows out from one country and flows into another country, So normally inflows and outflows should be the same. So I am underlining the fact that it should be the same, but they are not the same. Actually, on one hand, there are statistical errors. So actually, statistics are always recalculated, many times recalculated, and sometimes we only find the final numbers 3 years after the publication. So some statisticians say that 3 years after the publication, after the recalculations, you can see the trustworthy final numbers. So on one hand, it can be statistical error. The other one is data provision error, because in some countries, these FDI projects are not realized within a time span of 1 year, but in many years. I tell you an example. You might all know that in our university, a science park is being built. It is going to be on the other bank of the Danube. It is going to be on the place of the biscuit cube, your biscuit factory, which is, this cube. It is called the cube on the other side of on the other bank of the Danube, which is a plot of land of 3.6 hectares. We have an amount of money of which we are building the science park, but we've got a time span between 2021 and 25. So actually, obviously, such a huge investment is not being built within 1 year, but it is being built within 4 years. So this is, again, a data provision error, because if I am asked about the number, I can give the total number for 1 year, or I can give the total number for 4 years. I can give an annual average, or I can give a precise amount that was used in each and every year. So this is the second reason for errors and mistakes, because countries are they are submitting data, but they are submitting data on a distorted basis, because they are just giving the entire amount, they are giving a yearly average, or they are giving precise numbers. But if in the case of the inflow or outflow numbers, the figures don't match, then obviously FDI inflows and FDI outflows on a total global number are not going to match either. I mean, on a total global level, are not going to match either. And there is a third source of mistake. So there is a third source of error that is because, again, of the currencies. You remember the Smithsonian Agreement and the gold standard system and everything that I have explained around Bretton Woods. So actually, we are facing the same issue. We are facing the same thing. The situation is that all these figures are calculated in US dollars. So if you look at the topping, the heading of the paper, then you can see billions of dollars and percentages. And actually, obviously, international trade or international investments do not only happen in US dollars, they can happen in each and every currency of the world, but the aggregation happens in US dollars. And actually, this is one of the source of mistakes, because exchange rates are calculated. And if the exchange rates for the inflow countries and the outflow countries are not calculated at the same time, then the exchange rates are a source of mistakes, of errors. So this is why I'm telling you that there are two main columns, FDI inflows and FDI outflows. And normally the numbers do not match, but you shouldn't be worried about the non-matching numbers. It only reflects the reality of data submission errors, statistical errors, and exchange rate errors. So this is what we have. Actually, to have the World Investment Report is brilliant, because on on foreign direct investments. And I think it is a huge learning material. So I'm really grateful to the UNCTAD, because a global community can learn from it, even if it is not an entirely precise document. So these are not facts, these are approximations. Okay. What I would like you to know now, so actually we do know the absolute numbers, and we know the relative numbers. Let's have a look at 2019 and the FDI inflows. We can see that last year, 52% of the global FDI did go to developed countries and 44.5% to developing countries. But if you add 3.6%, the figure for transition economies, to 44.5%, then you can see that actually it is around 48 and 52. So generally, what I told 10 or 15 minutes ago, that half of the FDI goes to developed countries and another half to developing countries, is still true. If you have a look at the least developed countries, then that is very sad. And among the least developed countries, the landlocked small developing countries and the small island developing countries are very much underperforming, especially the small island developing states. And the reason is that the only reason why you go to small island developing states is because you want to do there something. So you don't go there accidentally. So you don't go there by chance. You must have something in your mind to go there. And unfortunately, these countries are not really included into the cobweb of the global economy. What is interesting to know is that almost 30%, 28% of the global FDI inflows goes to European countries, namely the countries of the European Union. And I equally would like to underline the fact that over 30% of the global direct investments goes to Asia, and specifically 25%, over 25% of the global foreign direct investments goes to East and Southeast Asian economies. So this is why I was asking Dr. Katalin, I don't know when, I think 2 or 3 weeks ago, to speak to you about regional integrations. Because as I said, the BRICS countries, so the BRICS economies are hugely important. Brazil, Russia, India, and China are hugely, hugely important. But if you look at the fact that East and Southeast East Asian economies attract a quarter, so 25% of the global FDIs, then you can understand that the 10 ASEAN countries, the Association of Southeast East Asian Nations, so the Association of Southeast Asian Nations basically are competitors and complementars of China and India in terms of attraction of global value chains. So actually the ASEAN countries attract capital very similarly to China and India. They are to the south of China and to the east of India, and they are on one hand competitors and on the other hand complementars of these two huge countries of the world in terms of being host economies for global value chains. Actually, I don't think that on the long run, the position of these countries is going to break. And even if global value chains are going to change into regional value chains, then these regional multinational companies in China, India, and Southeast Asia are predicted to remain very strong, and they are going to be strong competitors for other multinational enterprises throughout the world. Okay, now we are up to go to section B, so from section big B to section small b, and we are meant to tackle FDI outflows. However, we only have 5 minutes left. And so at the beginning of our next class, I would like to expand, I would like to touch upon the top 20 home economies of foreign direct investments. So this is about outflows. This is where I would like to start next week and explain the 20 biggest investors of the world that are the home economies from where FDI comes from. But actually, because we now have got 5 minutes, I'm going to stop right here. So I'm going to stop right here and I'm going to ask you if you've got any questions, because we've got 4 more minutes. So I'm not going to go to detail. I leave the room for questions and remarks if you've got any questions or remarks concerning the class or outside the class or everything that you might be interested in. Was it clear?
Yes, it was.
Yes.
Yes.
Can you follow me? Is it okay?
Yeah, it's okay
Yes.
for me.
No questions? Really?
Well, I have just one question.
Yeah. Please go ahead. Please go ahead.
Just about this value chain, so that you say that it's going to be regional. Do you think that it will be temporary, so for the next 5-10 years, and then it will go back to global, or will be more, how to say, a tendency to remain at the global level?
Yeah, actually, it's a very good question, and I do understand you. This is why I told you to kindly reach out to Alan Rugman and to his book, Regional Multinationals. I will tell you very honestly, I think it will depend on the sector, because in the manufacturing sector, I think it will shrink and it will remain so. I'm not sure for the next decade, but for the next 5 years for sure. So I think it will break up. So value chains will break up and they will remain regional. However, if you look at the service sector, and I'm going to tell you a few examples. So if you look at Google, if you look at Amazon, if you look at, if I'm telling a Chinese example, Baidu, if you look at Facebook, Twitter, and so on and so forth, so Wish or all these companies, then actually these are global companies. They are even called born global. So these service companies that are all internet-based, these are all internet-based service companies. They are basically born global and serve global. So if it entails the primary sector, if it entails manufacturing, then I presume it is just a presumption, because obviously I cannot prove. But as for the primary sector and manufacturing, I reckon that it is going to stay regional, not for eternity, so obviously not for always, but for a long run. And this is why at the beginning of the class, I was underlining that actually we didn't even catch up with 2008. So what do we expect? Actually, we are crawling backwards like a crab. However, there are some companies, especially service companies, that are not really affected by the crisis. So there are always exceptions. And actually, some companies are even thriving on the crisis, capitalizing on the crisis. And these service delivery companies that are internet-based are very much expanding. So this is, to be very honest, I think it is sector-specific, very much sector-specific. I don't know if I've answered your question.
Yes, well,
yeah.
Yes, thank you.
Okay. Have you got any more questions, please? Okay, no more bets. Very good. So then have a nice week. Please enjoy yourselves. Please concentrate on your studies. Please register for vaccination, and we will see each other within a week. Okay?
Okay, thank you very
Thank you
much.
very
Okay.
much. Goodbye.
Have a nice day.
Bye.
Thank you.